More and more people raise concerns about a potential AI bubble, about potential overinvestments. Hundreds of billions of dollars get pushed into various projects. The question is this sustainable? Will this continue? And if yes, for how long? It's hard to make any sense out of this because those numbers aren't necessarily something we deal with every day. Every time the numbers get bigger, and one of the reasons why they get bigger is because the monetary base is devaluing. So the amount of US dollars grows by roughly 6.8% every year. This is USM2. It's a trend that's quite consistent over the last 66 years. And so yes, it's true that tech stocks are at an all-time high. This vertical line here represents when Bitcoin was created, by the way. But really, since there are more and more dollars floating around, what does an all-time high really mean? This chart here might be a bit more useful. This is the Nasdaq 100 relative to the money supply. A chart that starts in 1985. And what we see over here, that's the dot-com bubble. Tech stocks in aggregate went down by 85%. We then didn't make any gains for the subsequent 6 years. And then only came the recovery. Now, there are several things to note here. First of all, we are at very similar price levels today compared to the peak of the dot-com crash. But secondly, what's maybe even more important, just because there was some temporary overinvestment into internet stocks at the time doesn't mean that the technology is not useful. Of course, the importance of the internet grew over the decades, but that doesn't mean that there can't be overinvestment. And we might see history repeating itself to a degree. Maybe in 20, 30 years, artificial intelligence will have taken over the world, but maybe right now there's just overinvestment yet again. So really what we want to do is we want to make comparisons. We have seen a bubble in the past. We have seen what happened in the past. We can then check what's currently going on. How are current valuations? We already know about tech stocks relative to the money supply, but let's have a look at the tech sector relative to the entire economy. Or to make it a bit more simple, this is a chart of the Nasdaq 100 relative to the S&P 500. How are tech stocks valued relative to all other stocks? Again, we've got the dot-com bubble. The decline was massive. It's almost 70%. And then we got our subsequent recovery. Yes, long term, I do believe that this chart should actually go up. First of all, technology becomes a more and more important part of all of the economy. But secondly, tech stocks tend to also pay out less dividends. And both the Nasdaq 100 and the S&P 500 are both price indices, not performance indices. So we could make the argument that yes, we are at very elevated levels, that this is not healthy. We could also make the argument that long term the Nasdaq 100 should outperform regular stocks anyways. We aren't accelerating in the outperformance of tech stocks as quickly as we did at the end of the 1990s. The valuation is high, but we didn't get there through short-term speculative exuberance. Now let's compare market caps. Nvidia has a market cap of 4.45 trillion. The money supply is at 22.2 trillion. So Nvidia makes up 20% of the entire US money supply. At the peak of the dot-com bubble, we had Cisco with 500 billion. With a money supply of 4.7 trillion, that was only 11% of the entire money supply. So this bubble seems to be worse compared to .com, according to this metric. Now, Microsoft had a similar valuation, roughly 500 billion. Whereas Microsoft today, it's at 3.8 trillion. Again, a similar valuation to where Nvidia currently is. Microsoft plus Nvidia makes up almost 40% of the entire US money supply. So clearly the market is currently running at prices that anticipates that everything will run via AI in the not so distant future. If there's only the slightest disappointment in the future, maybe there's even a fraud case in one of those companies, confidence could come down very, very quickly. That is what happened with the dot-com bubble. There used to be EMTV with a big accounting fraud in the German new market. So that was the Nasdaq equivalent. Now, tech stocks relative to the general market are currently expensive, but even the general market itself is expensive. What we've got over here is the Shiller PE ratio. So the price to earnings ratio is 7-year moving average. This is an extremely long-term chart. It starts in 1871. So 150 years of data. This here is the dot-com bubble. So first we had the dot-com bubble crash, then subsequently the global financial crisis, and Bitcoin was created over here at the bottom of the crisis. Now this chart is problematic for several reasons. Whenever we buy stocks, we are essentially buying the future earnings of a company. So when the Shiller PE ratio is high, this is not just a random indicator. It shows us that currently the valuations of stocks compared to what they deliver is very high. But the second problem is that Bitcoin was created here, and we don't really know what happens to Bitcoin during a real crash. If suddenly the AI bubble pops, what's going to happen with assets that are seen as even more risk on? Because here's the problem, Bitcoin really is not a risk-off asset yet. In theory, it's digital gold, but during the COVID crash, it went down by more than 60%. It was not a risk-off asset. Gold was a risk-off asset. Bitcoin was just a levered bet on technology stocks. And so all those fancy models that we have about Bitcoin, when historically it's a great time to buy, maybe those models will break when we are not anymore in an environment where risk on assets expand in valuation. So again, this is the stock market relative to the future earnings. We can also have a look at the stock market relative to the gold price. This is a chart again that starts in the 19th century, in 1884. The dotted line here, that's the average ratio. So the S&P 500 relative to gold. What I find interesting about this chart is, first of all, that it's not necessarily that clear that stocks outperform gold long term. We had periods where both asset classes returned the exact same that lasted for almost 100 years. Instead of following the official narrative that stocks is productive capital and gold is just dead capital that doesn't do anything, let's just look at the real performances. If stocks are so much better, shouldn't we see much more long-term outperformance? What I think really what's going on is that sometimes the market is getting risk on, sometimes it's getting risk off. And that effect is way stronger than the long-term outperformance of stocks versus gold. This crash here of the stock market relative to gold was 94%. Had you bought gold at the end of the 1960s instead of stocks, you outperformed the equity holder by more than 10x. If you turned this around and you bought stocks at the beginning of the 1980s, you outperformed the gold holders by a 30x. So really navigating those macro trends and be somewhat opportunistic instead of idealistic and just focusing on a single asset class, I think is the key to success long term. There are times when the gold bucks make all the money. There are times when the equity holders make all the money. And the best is to adjust positions accordingly. Now everybody talks about gold's great performance recently, but still, relative to equity prices, it's not historically high. Equities are still higher over the very long term. Now, I do understand how it can be scary to buy gold. And I actually sold some of my gold because of this chart, but I re-entered again. And here is why. This is the gold price relative to the monetary base. A chart that starts in 1960. The dotted line is again the average price. And yes, we are above the long-term average by roughly 60%. And we are very close to the peak in 2011. And this chart alone very much justifies to just sell the gold now. The question is, sell it against what? Sell it against equities is probably a bad idea. Sell it against property is probably also not the greatest idea. Selling it versus US government bonds isn't that great either, because the debt to GDP in the US is so high and there might be monetary debasement. So really there's no great alternative. And here is why I bought back into gold despite this extremely unpleasantly looking chart. Yes, there might still be 187% upside, but again, if we look at the current price, we haven't been much higher very often, only during this bubble phase at the end of the 1970s. But my impression is that the momentum in gold is still very much intact. People are looking for new risk-off assets. When everything is so expensive, when everybody is speculating so heavily on the AI bubble, there needs to be something where the money can be parked. Have a look at the year-over-year gold reserve changes by the central banks. We see roughly 500 tons of gold getting purchased every month. And that is quite consistent for the last 7 years, when gold moved from 1,300 to our current prices. At the same time, we've got gold ETF purchases. That's 16 million ounces per month. That's also roughly 500 tons. So in total, we've got 1 ton of gold getting purchased by those two entities. The total above ground supply is roughly 200,000 tons. So the entities buy up roughly 6% of the entire supply every year. And this is constant, right? This is pretty much every single month. For the ETFs, it's a bit more fluctuating, but at least since beginning of the month, it's still very constant. If the ETFs are selling while the central banks are buying, the gold price seems to just go sideways. So the ETF purchases are much more speculative than the central bank purchases. But I think central banks are buying more consistently and very long term for two reasons. The first reason is the worry about monetary debasement because of the debt to GDP ratio in the US. The second reason is that the US dollar isn't that great anymore of a reserve currency. We have seen Russia losing their deposits because of the invasion in Ukraine. Thus, the US dollar is becoming now a political asset. If you don't align with the foreign policy of the US, then whatever savings you have in US treasuries might just become worthless. And so central banks are simply fleeing away from the dollar, which will, of course, have long-term, extremely negative ramifications for the US. But since we see those purchases every single month very consistently, I am okay to ride this current momentum in gold despite the high prices. Gold is above its average price relative to the money supply, but really I think stocks are way more dangerous given all of those funny circular deals that are currently happening in the AI space. And so my approach to this is to be as cautious as possible. I also buy physical gold now every month. I'm not alone with my assessment. Have a look at this here.
So I think the AI bubble is a bubble and it will pop, but I think of it more like the dot-com bubble, which is to say the internet came of age in the late 90s and there was a pop, but the internet is still here and is more powerful and a bigger force than ever. So I think something like that will probably happen with AI, meaning there's definitely overinvestment and probably investment in the wrong areas. And so there will be some kind of comeuppance. I don't think that means that AI is not a thing. I think AI is probably, a generational shift for everybody.
But there will be a correction.
There will be a correction. The question that we don't know this time around is if you believe that every financial crisis is a function of too much leverage in the system, too much borrowing money, right? In 1929, it was too many people borrowing for stocks. In 2008, it was too many people borrowing for subprime loans and the like. It could be that there's too much borrowing going on around these AI data centers. People don't appreciate, yes, Google and Facebook, they're all spending hundreds of billions of dollars, but to build these data centers, there's energy companies that are taking on an extraordinary amount of debt, construction companies, real estate companies. I mean, and that debt we can't see anymore. That's actually another big thing. It used to be that you'd get a loan from a bank, and so the system could see the debt in the system, the leverage in the system. Today, it's all moved into what they call the shadows, into this private credit business. And so we don't really know what's going on. And that's a little scary. And I'll give you one more little, not to scare everybody, but you're starting to see what they call round trip deals, these like circular deals where, so Nvidia and OpenAI did this very unusual deal a couple weeks ago where OpenAI is buying chips like crazy from Nvidia. But OpenAI can't afford to buy all the chips that it's committing to buy. It doesn't make money. It's losing money right now. So what's happened? Nvidia invests money into OpenAI. So they have now committed to give them $100 billion, which then they're going to take the $100 billion and buy the Nvidia chips. So it's a completely circular transaction. It's like magic. And then just, I think 2 weeks ago now, a similar deal. OpenAI is going to buy chips from AMD. Can't afford to buy the chips in AMD. Says to itself, well, if we announce that we're going to buy chips from AMD, AMD's stock is likely to go up. So we're going to get a stake in AMD, and when the shares magically go up, we'll now have money from those, and then we'll go buy the chips.
What's wrong with that?
Well, it just reflects that there's not a sort of underlying stability in that market. When you get into what's called vendor financing, when the vendor basically has to finance you, it can come back to bite you. Now, yes, if OpenAI turns out to be a massive success and super profitable, maybe no harm, no foul. But if it doesn't, the whole sort of ecosystem can break.
And so I fully agree with this assessment. The issue is that OpenAI is spending more money on processing power than it makes money from the subscriptions. The circular trades have been very well described in this video over here by Hank Green. The state of the AI industry is freaking me out. And there's another summary video by CoffeeZilla, the state of the AI bubble. So I'm not completely alone with my assessment. Tech stocks are incredibly high relative to the monetary base. They're very high relative to other stocks as well. Individual companies now make up massive amounts of the monetary base, more so than they did at the peak of the dot-com bubble. And it's very hard to say what the right course of action is. The only thing that I do know is that the decision what asset class to invest in matters more than most people are aware of. If stocks decline relative to gold in a similar fashion as they did in the 1970s, we might see gold holders outperforming by 10x. And because of that, owning at least 10% of a portfolio in gold, I think, is very much justified. If you're buying tech stocks at this price, you might as well buy gold at this price. Yes, it's not as attractive as it used to be 1 or 2 years ago, but I was talking about gold actually already at that time. Still, the demand for gold is very constant. The central banks don't want to hold US treasuries anymore. Which then, of course, has another implication, right? We don't really know what happens with the whole US financial system if suddenly the debt can't get rebased that easily anymore. Now, I'm not a prophet. I don't have a crystal ball, but here's a potential scenario. We might see something very similar to what has happened in the 2000s. As in, first we might see our tech collapse, right? This was .com, then a slight recovery, and then a systemic issue with the US financial system. As we had here, this was the global financial crisis. This is when Bitcoin was born. So a double whammy, maybe we see the same again. Maybe an AI bubble crunch, and then afterwards a US debt-related crash. And the asset that would benefit from such a development is, of course, gold. Now, I try to be as objective and as realistic as possible on this channel. I try to not just sell the greed, talk about 100 or 1000x cryptocurrencies, where then in the end, most people end up losing their money. This is what I don't like about the crypto space, especially on YouTube. Here is a possible 100x crypto, or over here, Plasma going to the moon with 100x, or here, even a ranking from 10x all the way to 1000x. The problem is that most people get burnt with content like this. They're hoping for the 100x, they put in all of their savings, and then that money is gone. Here's the sad reality. The vast majority of altcoins is just going down all the time. This is an overview of smaller altcoins and their performance in the last year. The reason for the underperformance is because insiders and early investors and the team, they get token allocations over time, and that increases the supply. The price is a result of supply and demand. And when the supply is just going up all the time and the demand cannot catch up, which is true in the vast majority of cases because of ever increasing competition and because our supply unlocks are also so extremely aggressive. Because of that effect, that's then the reality. That's why most altcoins do worse compared to Bitcoin. So this is an example of DYDX. That's this chart over here, right? The supply development. This is DYDX relative to the Bitcoin price. This is not pretty, right? This is an underperformance of 99%. And while it might not always end up with minus 99%, many altcoins still end up losing. Owning a diversified portfolio of assets where the insiders cash out all the time is a bad idea. But it's a good idea to do the exact opposite. So instead of buying DYDX in this example, we can do this here. This is now the Bitcoin performance relative to DYDX. So we bet on rising prices of Bitcoin and at falling prices of DYDX at the same time. So in this example, since the beginning of the year, that made 210%. The performance over the last 2 years is plus 1,300%. So this is where we can find the 10x returns, or at least the outperformance over just buying and holding Bitcoin. We want to work with the market structure. The market structure is against the retail investor more often than not. Again, most altcoins tend to do worse than Bitcoin and Ethereum most of the time. And we don't even have to be afraid of so-called altcoin season, right? When the others' dominance went up by 67%, At the same time, this relative valuation still didn't go up. So the other's dominance is just a measure of market caps. It's not a measure of price developments. And when market caps stay stagnant because the price gets cut in half while the supply doubles, this is not reflected in the typical altcoin performance charts. I've been following this strategy for the last 4 years. So this is a monthly return chart. Had I just dollar cost averaged into Bitcoin, I would have gotten the line in gray. But because I also bet on falling altcoin prices, I got the return in black. And this is really how we make money in crypto. It's not about finding the next altcoin. It's not about hitting a home run. It's about long-term compounding capital faster than the average. It's about being on the same side as the small circle of insiders. Basically flipping this chart around. Everything that's red here becomes green. Everything that's green becomes red. So the vast majority of our trades end up winning. The strategy might not be as straightforward as just buying an altcoin, but it's also not too complicated. There's only 2 videos that are really important. It's this one over here, using perpetual futures to bet on relative valuations. And it's this one over here, probably even more important, risk management with relative valuation bets. The first video is 34 minutes. The second video is 28 minutes. Once you've watched those 2 videos, you know exactly what to do in order to get this kind of performance. And I'm so certain in the strategy that I will send you my favorite trade directly after joining the premium membership here. So you will get my favorite trade. And if that favorite trade is not making money in a span of 1 month, so you're holding that trade for 1 month. If you're not in the green with that trade after 1 month, then I will refund you the membership fee. So really, you are not risking anything. After joining, once you've watched the 2 videos and you've opened the trade that I will share with you, and you're not making money, you just get the $125 back. If you do make money, of course, that's great. Then you can just continue copy trading me. I share every single trade in real time in premium as well. A link to premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.